Warren Buffett, we all know, one of the greatest investors, is sitting on $300 billion in cash right now. And that $300 billion cash is 27% of the total assets in the company. And the company usually holds 13% in cash, but right now they are holding 27%. That's more than double. So we need to figure out what's the reason they are holding too much cash. Is a crash coming? Is the recession coming? Is Warren Buffett predicting something that a retail investor or the normal investor or the beginner investor they can't predict? So let's understand from the point of view of Warren Buffett how he did some adjustment in the past and how he's predicting the future and how we can be well prepared. So we can learn lots of things from Warren Buffett. He's more than 90 years old. He has lots of experience in investing. He started investing when he was only 14 years old. So he has been investing more than 80 years. And I'm not saying that copy Warren Buffett, do whatever he's doing and you have excess cash, because Warren Buffett has different story. He has lots of cash, but we as a retail investor don't usually have lots of cash. So we can learn lots of things from Warren Buffett and don't have to copy. We don't even have to like him. Just need to understand how his strategies works and we can implement the same and have good investment returns. So right now it's 2025 October and last time he has 25% in cash and assets was in 2004, and that's right before the great financial crisis in 2008, the housing crisis that happens in 2008. And in 2004 he has 25% of the cash sitting in his investment. And if you read the article in 2004, he said that I don't find any good investment opportunities. Everything is seen overvalued and I can't find anywhere to park my money. And that's exactly what he is saying right now in September 2025 and from past 2 months. And you remember in 2025, in April, there was a little correction in the stock market. He had a lot of cash in that time too. And then he buys some good investment when the market dropped in April. And he's saying exact thing right now as well. But he's not saying that I see the recession or the correction coming in next year, but he's saying that I'm seeing a correction on the market crash in next year, 2 years, or even next 5 years. So we can't just say that the market crash is coming, sell everything and then buy at the low, because we don't know what's going to happen in the future. What he's saying right now is that he can't find any good opportunities in the stock market to park his money or to invest his money right now. So he just last month he invested $1 billion in United Health, and that stock he find it undervalued at that time because the companies had good fundamental. It was just the CEO thing that the stock prices fall. So he put $1 billion in United Health and he's saying that he can't find any good opportunities. And Warren Buffett, he's an active investor. He look for the opportunities. He don't wait for recession, crash or correction coming in the stock market. He is an active investor. He looked for the good opportunities so he can invest his money. He invested $1 billion in United Health and some other stocks as well. And the biggest mistake we as a beginner investor make is that we don't have enough cash to buy the stocks when the correction comes. And that's what used to happen to me. When I have little extra cash, like let's say as a beginner I have $2,000 to $3,000 or even $5,000 sitting in a cash, I don't have patience to wait for the market to fall. I just use that cash and invest in something that I'm not supposed to because I have that cash extra sitting down. I don't want cash in my account. I just invest the money in the stocks that I find good. So that's what I learned from Warren Buffett, is that if you have excess cash, just lose that cash to the inflation. Don't just persuade from something and then invest in a stock market when they are at all-time high. But I'm not saying that when the market is overvalued or is at the all-time high, that you don't need to invest your money. Just keep piling up cash and then buy when the market is low. No, I'm not saying that by any means. So what you can do is that buy your favorite index funds or ETF. But my strategy right now is that S&P 500, SCHD, QQQ. Those three ETFs, doesn't matter if the market is up, doesn't matter if the market is down. I invest in those ETFs every week. Some amount, not everything at once. But my simple strategy is right now is that individual stocks, I don't force myself. If I have extra cash to buy those stocks, I just keep on investing in those index funds or ETFs so I don't miss on the gains. Because I don't know when the recession or when the crash is gonna happen. It might be in 2026, it might be in 2027, it might go till 2030, who knows? People are saying there's an AI bubble, but who knows when it's gonna pop. So that's why I'm keep on investing in the index funds. I don't want to just watch the market and then pray that the market will come down and then I'm gonna invest my money. That's a really bad strategy. As a beginner, don't expect the stock market will fall and then I buy the stock. Let's say you bought a stock at $20. When the stock was $20, you bought a stock. And now that stock is at $60. So you're at $40 gain. So now you're thinking that the market is at all-time high. What should I do? Should I sell the stock at $60 and then buy it back when it's gonna be lower. So you bought it at $20, you already have $40 gain. Why should you sell when the stock fall to $30 or $35? Buy more. Dollar cost averaging is the best strategy in the stock market because you will not know when the market is at all-time high, when the market will crash. So dollar cost averaging is the best strategy right now. Before we jump to the next point, watch this video from Warren Buffett. So there are 3 strategies Warren Buffett talk about when you have extra cash pile up. First is strategy, capitalize, and emotional. So we're gonna talk about strategy. So Warren Buffett, he's an active investor. He looks for great opportunities in the stock market and buy when the company is doing good, but it's undervalued. So he's an active investor. He usually sells the stocks that are not doing good. Like in the last couple of years, he sold billions of dollars in Apple stock. And he buys the companies that are doing great. So he's an active investor. But the important point here is that you don't need to be an active investor to be a great investor. If you're a passive investor, be a passive investor. Don't get stuck in be an active investor because you're saving you a lot of time and a lot of stress and potentially lots of money if you're a beginner by just be a passive investor. And that's what Warren Buffett say. If you're a passive investor, be a passive investor. The simple strategy that passive investor must have is that A, B, B. And that's always be buying. Doesn't matter market is up, doesn't matter market is down, but look for good opportunity. But be a little smart. When the market is at all-time high, have some extra cash, but when the market is at correction, buy with that amount. And as a passive investor, you don't need to look at the financial statement. You don't need to wake up early in the morning and then look at the Wall Street Journal, what's happening, what's going on with the company. So as a beginner investor, you can always invest in VTI. So Vanguard Total Index Fund. It tracks all companies in the United States that are public. So you don't have to worry about anything. If the US economy is going up, then your portfolio is going up. If there is a correction, your portfolio will be down. So you don't have to worry about anything if you're just investing in VTI. So there is another index fund, my favorite, S&P 500 or SPY. So as a passive investor, you don't need to worry about what's going on in S&P 500, which 500 companies are coming in, which are coming out, because the best 500 companies will always be in S&P 500. So for example, let's say Apple, they start producing iPhones that people don't like, that people don't trust anymore. People start buying Samsung and they're not buying Apple anymore. And the Apple has bad fundamentals, and everywhere people are saying that Apple is a bad company, and then their fundamental falls, their profit falls, and now Apple is bankrupt. They're doing really bad. So what's going to happen? If you just invested in Apple, you probably lost all your money. But now you're in S&P 500 and the Apple is in S&P 500. So what S&P 500 is going to do is that they're going to kick that company out and they're going to bring another company that has good fundamentals. So that's the biggest advantage of investing in S&P 500 and as a passive investor. If you want to be more niche, you can invest in QQQ. So that's technology ETF. So if you want some more growth, if you want to be more in Nvidia, Apple, Microsoft, so you can invest in QQQ. They have more growth, more risk. So more risk, more reward. If you want some dividend, you want some cash flow, you can invest in SCHD. They give you around 4% of dividend every year from past many years. The strategy I use is that I invest in all 3 of those. Some money in S&P 500, some in QQQ, some in SCHD. So I have exposure to everything, to the dividend, to the growth, and to the US economy. And the second thing Warren Buffett talk about is capitalize. And there are basically 2 opportunities. One is economic opportunity and the second is stock opportunity. So what is economic opportunity? So interest rates are at all-time high. Businesses, they have very hard time to get a loan. Many businesses are failing. Housing affordability. People can't afford houses. Unemployment rate. All the economic things. But I'm not saying that because of all these things, the recession is going to come. Recession might take 1 year, 2 years, 5 years, but it's gonna happen. But market crash gonna happen, market correction gonna happen. There will be bear market. But there is an always economic opportunity. When the economy is bad, when the market fall, you can buy more and have good returns in the future. And the second thing he talks about here is that stock opportunities. When the company has good fundamentals, company is doing good, but because of some bad news, and that's what happened with the United Health. They have good fundamentals, good company profits, and still the stock prices fall by 50%. So good companies with good profits, with good fundamentals, but temporary setbacks. That's what Warren Buffett talk about. That's where we can make good profits in a stock opportunity. And the third is emotional. So people are emotional. So TikTok, Instagram, YouTube, you can see many influencers. When the market is at all-time high, people get emotional. People say the market is always going to go up. I'm going to put all my money, all my savings in, and then I'm going to have good profits in the future. But when the market goes down, that's where the real opportunity is. And that's when people get emotional, they get fear, and they don't invest at all. So people are emotional, and because of this, they lose many opportunities in the stock market. And we can see a lot of this happens in when the market crashed, when there was a COVID. People get fear, people get scared, and then they don't invest and they miss on big opportunities. So that's all for today. And if you like this video, please give this video a thumbs up and subscribe to my YouTube channel. And I'll see you in the next one.